Bruno here. When I first meet a client, I set up the bones of a roadmap for them. But before you can do that, you have to establish where they're starting from and where they actually want to end up, their finish line. Now, in the concept of selling your business or exit strategy, the starting point would be their current value and the finishing point would be their sell price. So we need to establish those two things before we can effectively map out this journey that they're going to take. And I'm going to show you how we can work out these two things in this video. Let's use this diagram to explain an exit roadmap. On the left-hand side, we have monetary value, and on the bottom, time. Majority of business owners do have an idea of what they want to actually sell their business for, their want price. A significant amount of business owners do not know or have an understanding of what their current value of their business is. Now, I've put the current value of the business below their want price because unfortunately that's where it exists in the majority of time. Business owners have a higher inflated value of their business, or they want more money than what the business is worth. But you do need both to get an understanding or the basic of this road map to where you want to go. However, I put it to you that this want price is not a true representation of what you need or your goal. There is another price, which I will call your why price. And if you can calculate and work out your why price, it will give you a better representation, a better idea of what your want price, what your sell price will be or should be. So keep in mind these three prices: your current value, your want price, and your why price. In the next bit of the video, I'm going to explain what is and how to calculate your why price. Okay, let's talk about your why number. How do we work that out? Now, there's two parts of it. There is what generally happens now and what I propose to do, and that'll be part B. Part A, we've got two examples, companies. One sold for $3 million, one sold for $500,000. I'm going to be mentioning the word tax, and I'm going to be mentioning the words return. This is not tax advice or wealth advice. That's something you would go to a professional about. But I use this to give you an understanding of what sums we need to be doing to get us to what our return would be on these figures here. Okay, $3 million business is sold, but you've got costs involved in selling that business. Your business broker, your legal fees. So let's just assume it's $400,000, take that off. Then you would be paying some tax on that. I don't know what the tax would be, but we need to put a number here. Let's say it's $400,000. I'd also recommend that if you're going to sell your business, reward yourself, enjoy yourself, buy something, spend something. And let's assume that you've gone out and bought something to the value of $200,000, which after all those expenses gives you $2 million in the bank. Now, if you were to invest that, let's just assume that you have a return of 4%, a modest calculation that would protect your principal and give you a return of $80,000 a year. So this example shows you that if you sell a $3 million business, then if you put in all the formulas, then you might come out with an $80,000 a year income. If you go to the $500,000 example, again, cost of selling your business minus $50,000, tax $40,000, spend some money on yourself, $10,000, you're left with $400,000. 400 times 4%, it gives you $16,000 a year. Certainly not an amount of money that would actually sustain you ongoing. So in this example, you probably would need to be supplementing this with some other type of income. But the key thing, the reason why I do this is to establish what is the end result of these funds here. So in the part B of the Y price, I'm going to be reversing this. So we're going to be starting here and working backwards to get our sell price. Bear with me, let me show you what I'm talking about. Okay, part B of the Y price. First up, let me tell you that this is a really simplistic way to calculate it. There'd be a few other things that you have to accommodate, your savings would actually affect the data here. But for now, I just want to keep it real simple. At some future stage, I'll deep dive on this and give some more in-depth examples. But for now, real simple. Let's make some assumptions of this person that is trying to work out their Y price. Let's assume that they're going to sell their business and that they're going to retire. After that, they're not going to need any income. They're not going to work or have any job after that. They paid off their home that they live in, and they want around about $100,000 to comfortably maintain their lifestyle per year. So $100,000. To work backwards on a 4% return, just times that by 25. That gives you $2.5 million. Forget about savings for now. We go straight into these sums. You've worked in the business for 10, 20, 30 years. Reward yourself with something, whether it's that sports car, that yacht, that diamond, whatever it is. You're going to reward yourself with a $200,000 gift. In this case, in this sums, we add that. You still have to pay that tax, and we've assumed that it's $400,000, and there is that cost of the business also, which again is another $400,000. Now, if you add all of those together, it now comes up to $3.5 million. So for you to walk away with a retirement income of $100K a year, you'd need to sell the business for $3.5 million. Okay, another quick example of working out your Y price. In this case, this business person, they're self-employed. There is only one person in the company. They know that because of the limitation of that one person and the industry, they would top out at a $400K sale price. It won't go beyond that. They plan to keep working after the sale of the business or go into part retirement. They're looking at a $15,000 extra per year that they need to supplement their part retirement or to add to their keep working. Now, we times that by 25, and that will give you $375,000. Okay, this particular person has been very diligent and saved a reasonable amount of money, and they have $100,000 in the bank. So we would minus that $100,000. And they haven't spent any money because they've really don't have a lot, so they're not going to reward themselves. They've worked diligently with their tax accountant, and they brought down their exposure to $15,000 tax liability at the end of selling that business. They've also worked a lot on their business in their exit strategy, and they can exit out of their business, sell the business, maybe not use a business broker, still use a legal representative, but let's say that their cost to get out of their business is $10,000. If you add up all of these figures, these are actually plus. We plus those figures, so 375 minus 100 plus 15 plus 10 gives you $300,000. This person would need to sell their business for $300,000, and they would be making $15,000 a year, roughly, based on a 4% return on the share market. Again, I'm making a lot of assumptions here, but it's a reminder of utilizing the formula, you populating the individual areas with you populate the tax based on what your tax agent would be talking to you about. You'd work out what your costs are. You'd get an idea of what your legal costs would be and whether you're going to use or not use a business broker. You know how much savings you have, you can add to this equation, and you know how much you also are going to reward yourself. So that's how we work out your Y price, which will get you to your true sale price of what you need to fund your lifestyle. Quick summary, don't let your sale price determine your lifestyle. You work out your lifestyle, and then that will determine what your sale price needs to be. But it does take time and effort and this exit strategy put into place. I've given you a basic understanding of how to work out your want price, which will allow you to have your sell price, which gives you your finish line of your exit strategy. But what about the starting point? How do you work out your current value? Well, for small businesses, the majority of industries have a formula that allows you to work out your current value. And that's a multiplier of profit or seller's discretionary earnings, or an accounting term, EBITDA, and in some cases, even revenue. But if you dig into your industry, which is what I encourage my clients to do, and work out what that formula is that applies to your industry, you'll be able to add the numbers to that formula and then get your current value. You've got the starting point and the end point. Only then can you map out what needs to be done. Now, if your difference between your current value and your sell price, your want price, is something small, maybe $100,000, and you've got 10 years to achieve that, that's something you could probably do by yourself. But if it's substantially more, 500K to maybe 1 million, and you might need to achieve that in 3 to 5 years, then I'd suggest to you that requires a lot more effort and also expertise, outside expertise. And you'll need to be finding people to help you along the way to get you to your price. Now, if this makes sense and you find this interesting and you think that maybe I might be one of those people that can help you, I might be that expertise, happy to have a preliminary discussion with you. Thank you.